Hey everybody, welcome back. We're on unit 6.6 and we're talking about real interest rates and international capital flows, okay? More specifically, we're talking about how changes in real interest rates affect international capital flows. Now, what are international capital flows? It's international financial capital flows. And what is financial capital? For all intents and purposes, it's just money, okay? Here's the thing, guys. When interest rates change inside of a country, it's going to change how money flows between countries, okay? So if we get a relative interest rate change, again, relative meaning an interest rate change in one country in regards to other countries, that's going to affect how financial capital or money is flowing between those countries. And therefore, it's going to affect the exchange markets, the exchange rates, and ultimately net exports of countries. So let's take a look at this, okay? I've got the United States right here, and I've got Europe over here, and I've set up a situation where the interest rates are currently, you could call them in an equilibrium in respect to each other. The United States, real interest rate, 5%, Europe's 5%. And now what we're talking about here is for similar financial assets, ones of similar risk, similar maturity dates, okay? So think about it that way. So equivalent financial assets as far as risk and maturity dates, they have an equivalent interest rate, all right? Now, what we can have is a situation that the central bank of a country, in this case we're going to have the Fed, the U.S. central bank, engage in either expansionary or contractionary monetary policy. What we're going to do in this particular situation is we're going to do contractionary monetary policy. So the U.S. central bank is going to do contractionary monetary policy. So let's go ahead and put the Fed on our board. So I like to do just put a little box right there. We'll write it in as the Fed. And it's contractionary monetary policy. So I always like continuing to use green for kind of the money aspect of this. What's happening to the money? Well, it's really not the money that's changing, but the monetary base that's changing. The central bank is pulling reserves out of the financial market, right? It's pulling reserves out. Now, how is it accomplishing that? Through what we call open market sales, okay? It's selling U.S. Treasury bonds to banks, and the banks are paying for those bonds with their bank reserves, okay? So that is a way to pull reserves out of the banking system. Now, when that happens, when reserves are pulled out of the banking system, we'll expect interest rates to change in that banking system. In this particular case, since reserves are becoming more scarce, okay, it's going to cause the interest rate to go up. So let's just say 6%. Again, this is contractionary monetary policy that the U.S. central bank, the Fed, is engaging in to drive interest rates up, okay? Again, they're doing that to cool their economy off, okay? To curb spending in their economy by making spending more expensive, by driving the interest rate up. Now, let's take a look at what's going to happen internationally to the financial account and the current account in the United States. So what I want to do immediately is start thinking about savers in the United States and savers in Europe and how they're going to react to this. Again, why am I thinking about savers? Because savers are the ones that have money. They're the ones that go through exchange markets. Certainly, borrowers are also affected by this interest rate change, but borrowers don't have money, so they don't go through exchange markets until they get money, okay? So I want to talk about the ones that have money right now. So how is the U.S. saver going to respond? What I like to say is this U.S. saver was probably taking some money to Europe and probably taking some money to their own financial markets. Now, when this happens, how is it going to affect it? Well, they're going to take more to their own financial market, but even more importantly, from an exchange market standpoint, they're going to take less there, okay, to the foreign exchange market. Now, to me, that's really simple to just say the supply of dollars, right? That's what the American saver has, is dollars. And since they're going here less, the supply of dollars is decreasing. And it's so important to understand that the supply of dollars is equivalent to the demand for, the demand for euros. Almost made a mistake right there. The supply of dollars is equivalent to the demand for euros. So the demand for euros is going down. We're going to supply less dollars because we want less euros. And the reason we want less euros is we want to go here less because our interest rate went up, okay? Now, how is the European saver going to react, okay? Again, the interest rate is higher in the United States. And I'd like to say that this, that was a weird pivot, sorry about that. Trying to think about how to orient that I don't come off camera right there, is, hey, they were taking some of their savings to the U.S. financial market, and they were taking some of it to their own financial markets. Now, how are they going to change in regards to this interest rate change? The amount they're taking to their own financial markets, okay, is going to, of course, decrease, okay? So it's going to become less. the amount they want to take to the U.S. financial markets, more. Now, again, this arrow right here pointing right at the exchange market, that to me is the supply of euros. That's the easiest thing to think about. This is the supply of euros. They're going to supply more euros, right? So I'm going to say increase in the supply of euros, which is equivalent, of course, to an increase in the demand for dollars, an increase in the demand for dollars, okay? So again, they're going to supply more euros. They're going to want those dollars so they can take their savings to the U.S. financial market. Now, what type of impact is this going to have on the currency? Well, all of these right here, all of those statements about the curves shifting are going to give us the same result, okay? A decrease in the supply of dollars causes the dollar to appreciate. Again, if the dollar appreciates, the euro must be depreciating, because what this really means is the dollar is appreciating in terms of the euro, right? So go over here, decrease in the demand for euro. Well, again, we already said the euro is depreciating, but hey, that's of course what happens. If we demand less euros, the euro depreciates. If we demand less of anything in this world, the price of that thing goes down, okay? Now, increase in supply of euros. If we increase the supply of anything in this world, the price of that thing goes down. So again, the euro is depreciating. Something we already knew right here. Euro's depreciating. Something we already knew right here. The dollar's appreciating in terms of the euro. And then again, demand for dollars, okay, is increasing. If we demand more of anything in this world, the price of that thing goes up. So the dollar is appreciating. What I'm trying to say is all of these statements give us the same conclusion. The dollar is appreciating in terms of the euro, and the euro is depreciating in terms of the dollar, okay? Now, with that said, what I like to do is go to my product market, because this is definitely going to impact my product market. Again, the dollar is appreciating. The euro is depreciating. This stuff is going to be looking cheaper to Americans because it's priced in euros, and the euro is cheaper for Americans to buy. This stuff is going to look more expensive to Europeans because this stuff is priced in dollars, and the dollar is now more expensive for Europeans to buy. Now, I want to look at this in kind of slow motion on how this is working, okay? So, here's the deal. That interest rate goes up in the United States. This European saver right here is going to come on out into the exchange market with their euros, right? So they're going to come out, they've got their euros right here in their hand, and they want dollars. Well, the thing is, what this is going to create is a surplus of euros at the original exchange rate and a shortage of dollars. Remember, Americans who have dollars are going to their own financial market more and coming out here less, right? The supply of dollars has decreased. At the same time, the demand for dollars has increased. So they're out here wanting to exchange, but there's just not enough dollars there. So what's going to happen? The dollar is going to appreciate. And when that dollar appreciates, again, that stuff begins to look cheaper. So the American consumer, see, again, all these weird pivots I'm doing, the American consumer, what are they going to do? They're going to come out into the exchange market, again, with their dollars. And now we're going to get what we want to happen right here is an exchange, right? The European is going to pass off the euros, okay, there goes the euros to the American, and the American's going to pass off the dollars to the European. I like to say it this way. The European saver is going to hand their euros to the American consumer, and the American consumer is going to hand their dollars to the European saver. So now the European saver has now got dollars. Remember, that person is a European, but they now have dollars. The exchange has been made, and that European can take those dollars to that financial markets. Now, as far as the top part, the product market, the current account, the American right here, now they are going to receive those euros, okay? That exchange has taken place. They've given up their dollars, gotten euros. And that American that's right there is going to go to that European product market and go and buy those products. That's supposed to be a green arrow, but what the heck. So they're going to go and buy those products. Now, let's talk about a few little things here at the end. This is a financial account. You can see the credits because the money's flowing into that financial account. That's credits to the U.S. financial account. By the way, debits right there. Debits to the European financial account. We can see the debits. Money's flowing out of the U.S. current account. Debits to the current account, right? We can even put net exports. U.S. net exports are going down. Remember, this stuff became more expensive when the dollar appreciated. Okay, getting debits here and credits to that product market over there. Now, there's one last thing I want to talk about before we finish this video, and it's these interest rates, okay? We were at 6% and 5%. I mean, actually, reverse the clock enough, we were at 5% and 5%. Then we did contractionary monetary policy in the United States, causing the interest rate in the US go up. And you got this kind of disequilibrium, if you will, 6% and 5%. But now take a look at this. Look which way the money is flowing. Money is going to flow into the U.S. financial markets. Well, this is going to be an increase in the supply of loanable funds heading into here. Well, what's the interest rate? It's going to start to push it down. And you're going to see this reduction in the supply of loanable funds here. What's that going to do to the interest rate in Europe? It's going to start driving it up, okay? On top of that, for a moment, let's talk about those borrowers. How are borrowers going to react? Well, if it's 6% here and 5% there, borrowers are going to head there. Now, I do this weird thing with my hand here. Like, I want you to understand, they don't have to go through an exchange market. They don't have money. But even borrowers from the United States could head over there and borrow, okay? And again, then they would bring their euros that they borrow to the exchange market, getting dollars. And you get that same exact flow that we had, okay? But anyhow, the bigger point I want you to get right here is the borrowers are going to go over here, demanding loanable funds. Again, driving that interest rate up. Less people are going to borrow here. If less people are borrowing here, again, driving that interest rate down. So here's the thing I want you to see. They were 5% and 5%. Then the U.S. interest rate went up to 6%. Then the behavior of borrowers and borrowers and savers internationally is going to drive those two interest rates back together again. Our new interest rate could be anywhere between 5 and 6%, but heck, it could be going to be 5.5. Again, why is that happening? Because you got this supply of loanable funds coming into this market, driving the interest rate down, and less borrowing, driving the interest rate down, okay? And then over here, you got more borrowing, driving the interest rate up, and less supply, driving the interest rate up. So this one could head to 5.5 also. It's not so important that they both hit 5.5. If it was 5.4, 5.6, absolutely. It's just that they would come back together in equilibrium because, again, these are financial assets of similar maturity and similar risk. And that's how it works. Hope that makes sense to you. Hope the pivots weren't too overwhelming, and we'll see you in the next video.